Last month, Nationwide reported an unexpected near 1% rise in house prices, defying predictions of another drop. While current prices remain 3% lower than they were a year ago, this surprising uptick has prompted some analysts to question if the market has bottomed out and if the anticipated correction in house prices has concluded. With inflation declining and interest rates potentially reaching their peak, could the much anticipated correction be over? However, how much weight should be given to a single month's data? To truly grasp what's happening with house prices and the housing market, it's essential to understand that various house price indexes are compiled differently. Nationwide's index, one of the most established, is based on its mortgage approval data. With a marked decrease in transactions, the index relies on limited data, necessitating considerable statistical adjustment. The Bank of England reported a continued drop in housing activity last month. With such low transaction volumes, monthly data can be misleading. Hence, it's advisable to overlook monthly fluctuations and focus on annual trends. Nonetheless, when data contradicts expectations or hopes, its reliability is often questioned. What we can ascertain about the UK housing market is a clear decline in transactions, mortgage approvals, and home sales. Prospective home buyers face more challenging conditions, resulting in a stagnant market akin to a poker standoff between buyers and sellers. Sellers are hesitant to lower their prices, while buyers are either reluctant or financially constrained. Zoopla's latest report highlights a growing gap between the rising number of homes for sale and the dwindling buyer demand. As any A-level economics student knows, this combination of increased supply and decreased demand should typically lead to lower prices, making the recent price rise particularly unexpected. But why is the market stagnant, and what will catalyze price adjustments? Housing prices are notoriously slow to change for several reasons, including homeowners' attachment to past valuations and the psychological aversion to loss. An example of this is the sunk cost fallacy, where past investments unduly influence current decisions. Homeowners struggling with this may miss opportunities, such as selling at a loss to move to their desired home. The lesson for sellers is to price homes based on current market conditions, not what they feel they deserve or past values. The standoff is further fueled by the repercussions of recent interest rate hikes on buyers. For instance, in 2020, a typical buyer with a monthly budget of £1,200 could borrow around £283,000 at a 2% interest rate. Fast forward to 2023, with rates at 5%, that same buyer can only borrow approximately £205,000, a stark reduction. Yet, this requires context. Since 2020, nominal wages have increased by roughly 16%. Adjusted for inflation, the same budget would now be around £1,392, allowing a mortgage of about £238,000, mitigated further by opting for a 40-year mortgage instead of 25. Higher nominal wages partly explain why the dire predictions of nominal house price collapses haven't materialized. Yet, despite wage increases, real wages have barely grown in the last decade, and it's the real prices, adjusted for inflation, that have declined significantly. Looking ahead, there is a cautious optimism for real wages as inflation is expected to drop. However, the impact of higher interest rates is yet to be fully realized. Many homeowners will soon face remortgaging at much higher rates, leading to potential distress and an increase in the supply of homes for sale in an already tight market. This, coupled with the dampening effect of higher rates on consumer spending and investment, suggests that the housing market correction may not be over just yet. Another intriguing aspect of the current market is the rise in cash buyers from 20% to 32%, with a simultaneous decline in buy-to-let investors. These cash buyers range from institutional investors to individuals who have cleared their mortgages. Finally, despite the persistent shortfall in meeting housing supply targets in the UK, questions linger on whether the construction of 1 to 2 million new homes, as promised by the next potential Labour government, is necessary to resolve the housing crisis. I hope you found this informative. Please remember to subscribe for more insights, and as always, I'll see you on the next one.